Good morning, everyone. Today is October 8th, Saturday morning. We're going to go over the custom index charts and the rotational modeling system status and the real estate market today. So what we're going to do, what I'm doing now is breaking these up into separate videos. I got tired of making separate parts and turning them into 40, 50, 60-minute long videos that I think everyone can appreciate. Let's keep them short, let's keep them simple, and I'll try to go over everything independently this way. So we're starting off here with the U.S. to Custom Global Market Index. The U.S. is the blue, the Custom Global Market Index is the red. Very simply put, I still believe these ultimate lows that I've been telling everyone for months are the absolute bottom in the market. I believe this is where we're going to find the global markets, try to find a bottom. We're very, very close to this. You can see we've had extended selling to the downside. The U.S. markets are slightly different. They're holding up quite differently than the global markets. And again, as I'd mentioned, this pre-COVID area that's right across this area, the early 2020s and the mid-2020s where the election took place, these highs and this range right in this blue box is where I believe the U.S. market is going to try to find support. Now, if you look over here on the right side, we're very early into that support zone on the U.S. side, and we're deeply below the initial support zone that I expected, which I thought we may find some support in this area going off of these 2018-19 lows, but we've extended below this area. Now we need to kind of watch this area to see if the global markets are going to try to rebound. What would take place with a rebound here is that we would have seen sufficient enough unwinding of valuation and asset values to now prompt the global markets as a, let's call it a reversion opportunity. If you take a look at this and you kind of draw a middle area right across this area, it's going to be right around in this area, 25, 30, 32%, right in this area. And if we were to get a reversion of this price, meaning price reverting back to the mean area, from this area down here to this area up here, it would prompt about a 22, 25% recovery, maybe more, in the global markets. If we were to see the U.S. markets do the same thing, a reversion to the mean would put us right about in this area, about where this red line is. And that would be, again, from where we're at right now, about a 17, 18% rally in the U.S. markets. If the global markets were to rally 20% off of these deep lows, the U.S. markets could actually extend a bit higher. So we're at a very interesting time. Still, I'm urging everyone to stay very cautious. This is not the time to get aggressive. You know, although it might be an opportunistic time to try to maybe take advantage of the deep selling in technology, but I'm going to tell you that we still need to stay fairly cautious. So I'm not urging any aggressive moves right now. Dabbling around with some technology or some miners or metals, I think might be worth it right now. Particularly maybe even getting into some depressed foreign market ETFs might actually be worth it right now. But stay very cautious with your position sizing. We could still see a bigger, deeper breakdown, kind of a capitulation low, let's call it, over the next couple of weeks and months. So we're kind of early in what I think might be a start of a Christmas rally, let's call it a reversion phase type Christmas rally, but we have no confirmation that this is happening yet. Okay. The custom U.S. Valuations Trends Index is still holding. This is a custom index that I watch quite extensively. It's an inverted system, meaning everything is upside down. So you'll see 0 and 100, 0 and 100, 0 and 10 roughly. But we are still holding above this purple line in early October. We are retesting these lows, retesting the June lows back over here. We are trying to hold above this level. The Fed's rate increase just a few weeks ago may have prompted some shift in consumer sentiment. I think it's a reactionary retesting of these lows. We'll see what transpires as we move further into October. So far, it's rather promising that these lows have held up. So we have to kind of I mean, it could break down, could come down into these lower areas. Remember, this was the 2018 lows. We could see a move in the U.S. market back down into these areas, but we have Fibonacci support right over here, which could play a very important role, this little red line right over here, and we need to see it kind of hold up. Now, remember, this is 2013, this is 14, this is 15, this is 16, 17, 18, 19, 2020s over here with COVID, and you can see this is essentially a rally phase after COVID and then a depreciation phase. So we may get a deeper low, but we're getting higher lows. So look at here, higher low, higher low, higher low potentially. This could be a very solid bottom in the market setting up. The volume ratio index was very flat last week. Obviously, with the selling that took place, and we're down near deep lows, this just tells you that there was some distribution in the market. We did not see a lot of accumulation, and we're likely to see some kind of a bump one way or the other, up or down at this point. We're kind of nearing that make or break area. The commodity to gold index is hovering down around 1. These are historically pretty deep levels, folks. Remember, in 2018, we had that deep selling down into this 1 area here. Then in late 2018, December, we got down here into this 1 area. COVID, when 2019, we danced around this area mid-July. COVID, we got really quite extensively deep, down to 0.8, 0.6. And then we rallied out of it, and now we've come down and depreciated quite well. Meaning this is unwound a lot of the, in my opinion, inflationary trends. There's still some lingering trends here, but the Fed has really taken the spark out of inflation, and the Fed would probably be very smart to sit or settle with moderate rate increases and let this continue to play out. Could we go lower? Oh, we certainly could. We could see this continue to extend all the way down into this 0.6, 0.5 area. But we are now consolidating very well into this red zone that I had warned for many, many months would be our ultimate target. And it's just going to be a matter of time before some impulse move, some shift in consumer sentiment prompts some sort of a rally. I'm still thinking that a Christmas rally, as I mentioned, may show up, but it might be fairly short-lived. It might be a 10, 20% rally in the global markets and the U.S. markets, and then stall out a bit more depending on what global central banks and the Fed does. Still, inflationary trends in commodities are deflating. The FANGs index, I mentioned this in one of the earlier videos, the 5-minute, which is now going to be a 10-minute video because I can't do them all in 5. Anyway, FANGs index and technology looks really promising to me. We don't have any confirmation of an uptrend yet. It is a very early warning signal. We have this standard deviation, the green channel across here. We're down near these lows. We've created an inverted hammer. We have deep low selling, starting to move a little higher, very deep stochastics levels here. This could be a very solid start to a momentum-based bottom in technology. And after the extreme selling that's taking place, I mean, some of these stocks have already fallen 50, 60, 70%, particularly the ARKK and ARKQ. You know, we may see a reversion rally, a Christmas rally, back from this 125 area here, maybe up into this 160, 170, 180 area. And that would be essentially a 35 to 40% rally in some of these stocks from these extreme low levels. It could go even higher, but I'm watching this with a lot of excitement, thinking that we're getting close to a bottom here. Okay, metals. Metals have done exactly what I expected. This deep low selling, and I will warn you that I believe long-term that we're in a depreciation cycle phase. In fact, I'm going to show you a chart here in a few minutes that's going to confirm this. And what's happened is we ended an appreciation cycle phase right over here at the end of 2019. And we entered a new depreciation cycle phase. In a depreciation cycle phase, which lasts about 9 to 10 years, metals tend to perform very well. It's a matter of a fear cycle where markets kind of unwind, general stock market, asset markets kind of unwind. Central banks have to do a lot of manipulation and positioning to try to deal with the unwinding process, and that creates a lot of fear. And fear translates into an overall bias trend for metals. You can see that going back through 2004, 5, 6, all the way through 2008, 9, 10, 11. In metals, if you take a look at gold during that time, you'll see it was kind of biasing to the upside, really just momentum, month over month, quarter over quarter, upward momentum. And maybe I'll try to show that to you in the next video. But at this point, we're nearing this apex. We've kind of come right to this point, right here with this apex. And now we need to kind of just see what happens next. I believe we're going to see gold up above 1875 by the end of October, possibly higher, back into this middle area, which would be about 425 on this chart. And we're going to probably see a new advancement phase in metals. It's just really that fear is starting to take over, that the central banks have unwound a little too much, and there's a lot of demand right now for metals. So hold on to what you have. Remember, we rode all of this contractionary phase down. We're now down at a very solid momentum base. We need to see this really move up and try to create an impulse move here and then extend a bit further. The Smart Cash Index, which is the same as that red line on the US to global index, formed a nice engulfing bullish pattern right over here, down near these extreme COVID lows. I'm somewhat optimistic here, ladies and gentlemen. I really am thinking that we're getting close to a bottom. I'm thinking that central banks are going to start to pivot slightly or telegraph future moves differently. I think that the global markets, which is what I was warning about way back in here in 1819, really have taken the bulk of the destruction, and I'm not sure that they can really withstand too much more at this point. Yes, they could go lower, but we're getting into this early bottoming phase. This is really the COVID low. This is going to be historical support. This is going to be a very critical price level for technicians like myself. So it would not be uncommon to see a reversion move back to the upside, maybe into this 150, 160, 170 area, kind of a technical bounce at this point. And that, again, would be about a 25 to 30% rally if it were to take place. Okay, we'll skip this real quick. Real estate, let's go to the U.S. stock market index. Is holding up near this lower channel. Now pay attention. This is the same standard deviation channel right here, going back many, many months, I believe back to 2016. And it's carrying forward across this channel. So this green area is our middle standard deviation channel. And then we go 1/2, 1, and then 2, or 1. So this is basically standard deviation 1, and then 1 and 1/2, 2, 2 and 1/2. So we're basically down here at a 2 standard deviation outside of norm to the downside, and we're attempting to find support above these pre-COVID levels, which is what I've been telling everyone. I believe we could see moderately strong support off of this Fibonacci price amplitude arc that is one of my proprietary little things that I do. But long and short of it, we're nearing this massive apex right here with what starts out here as an inverted hammer type of formation for early October. This is a weekly chart. So understand that we could get a nice solid bounce. We could get a nice reversion channel, maybe back up to this purple line up here, which would be about a 15-20% rally in the U.S. stock market. Now, where it goes from there, I'm unsure. We could start a wave 5 rally, carrying it much, much higher. We need to kind of play this week by week. I'm expecting a Christmas rally to kind of set up this year. I think the markets have unwound sufficiently. The Fed is a little behind the curve. They would be wise, like I told you, to pause or raise rates very lightly right now. But we're getting early warning signs that everything is unwound moderately well and fairly orderly at this point. So I'm kind of moving towards a reversion channel taking place. We could still see a big breakdown. It could still happen, ladies and gentlemen. Some news event, some crisis event. But if barring any major crisis event, we're looking kind of bottomy right now, in my opinion. and I'm going to show you some others as we move forward. Okay, the Valuations Index, very solid bottoming type of formation. We're way down into these deep, deep lows where we have historically seen the markets revert back to the upside. You can see this is this is pre-COVID. This is the COVID area. So this is 2018 early lows, 2018 December lows, 2016 lows. These areas right above this purple line or right in this low range here typically prompt some sort of a bottom or base in the market. These are very deep valuation levels historically, and we are very, very close to these levels right now. We could extend many weeks into this area, but we have a couple of things working in our favor. Number one, the shift in the European Central Bank. Number two, the Christmas rally phase, the start of Q4 in 2022 and Q1 2023, which may be somewhat positive. The U.S. markets are still quite positive in regards to earnings. Now, not everything is going to be beautiful, but we could have a fairly solid earnings season through the rest of October, the end of Q3 2022, which is happening right now and will continue for the next 25, 30 days plus. But we could see a real big shift in expectations going into Christmas. We need to see how it plays out. Q4 and Q1s are typically very positive overall. And because of that, I think we're nearing a momentum-based type bottom right now. Next, the Volatility Index. And again, it was higher prior to the big selling on Friday. It is attempting to hold up. This is a very solid inverted hammer type of pattern. And again, it is moderately bearish. If I were to give you my interpretation right now, this is the biggest fear factor right now for taking any aggressive move in the market. This tells me we should be staying very comfortably in cash. This tells me we should not be taking aggressive moves. We should be looking potentially for a bottom or a breakdown, so it could go either way, up or down here. My gut tells me that it's going to try to recover back to the upside off of earnings. I believe that's going to happen probably with a 60 or 70% probability, but literally some crisis event could take place, defaults or who knows. But long and short of it, and that could cause us to break down. A breakdown event at this point would likely move us below 4, back like we saw back over here in these areas, move us below 4, form very immediate support, and try to form a base and move higher. The only thing that would take us into an extended, deeper decline would be some sort of a, mass war. I don't want to call it nuclear, but, some kind of a major event. This was COVID, and it extended very deeply down in here into the 1.2 area. This was extreme deep selling. Typically, we get below this 6 level and we bounce back up. We get below 6, bounce back up. Get below 6, bounce back up. Get below 6 briefly, bounce back up. We're kind of at that range right now. You can see it right here. 6, recover. 6, recover. 6, recover. 6, possible recovery. And this is because the psychology of investors is, nobody really wants it to go down. Nobody really wants it to crash. We are inherently hardwired to somewhat be optimists. So with positive earnings, with some positive foresight from the Fed and central banks and positive expectations, there's probably a 60, 70, maybe 75% chance we get some sort of a moderate Christmas rally, and it could extend a bit longer than most people expect. Next, okay, we're back over here to the custom indexes. I think that's it. Let me just check. Yep, that's it. So now, we've gone through all of the custom indexes. What I'm going to do now is I'm going to go over the MENT Rotational Modeling System status. The Rotational Modeling System status has not changed. We have our independent weekly, which we are still bullish on the SPY with a 25% allocation. We've got 13.61% as of the close on Friday. Daily, we are bearish with 75% of our allocation. From our entry price of 399.93, we are positive 9.29%. And our net consolidated position, which is one position, would mean that we are bearish 50% of our capital with a 9.29% profit and sitting in cash with the other 50% of our position. So I'm trying to set these up to show you what's going on. We have the longer term weekly, which is still bullish, the shorter term daily, which is bearish, and that consolidates into this, which is bearish 50%, cash 50%. Ideally, what will happen here, ladies and gentlemen, is we will get some sort of a transition into both bullish or both bearish, meaning we will move into 100% bearish or 100% bullish as these two rotate around. Okay, next we are going to go to the historical performance. This is updated as of, actually as of the end of September. You can see it's performing very well so far for the year 2022. The rotational modeling system is off 4.72%, which, considering what many others are off 15, 20, 25%, you can see that we're holding up quite well. We did quite well in 2021, which is really, really stupendous. In fact, we've done quite well over the past couple of years. The rotational modeling system is your long-term, let's call it major equity, or the bulk of your equity should theoretically be deployed in this type of a system. Slower, longer, very easy to follow, trades maybe 6 or 7 times, 8 times a year. But you can see consistently this is going to keep you in the right direction as the market moves. And then we have our allocation tables. We've had a slight change here with, let's see, this is it. So we've had a slight change here. I believe it was in the YM. Yep, YM moving bearish, bonds moving bearish. We're going to hold on to everything just the way it is. If bonds do not form a bottom, which they've been kind of just drifting, then I'm going to reallocate these, move these out of cash, these bond positions next week, and we're going to see what happens, and we'll move those back into cash and get prepared for what might become an early stage rally in the NQ and the ES. We're just not seeing bonds perform yet. They will start to perform when the Fed pivots, when central banks pivot, move into a somewhat easing scenario. The deep, deep low that we're seeing in bonds right now is creating a little bit of pressure in our portfolio, and I had expected them to start to bottom a little bit earlier, and that's why I kept them hedged. Remember, our cash is doing well, our stocks are holding up okay, especially if you're following the TT scanner hot list. Metals are really basing, getting ready for what may become a 70, 80, maybe 100% move higher, which is great. But bonds have been weaker. They've been off by like 8, 9%. And this is becoming a little bit of a draw on our allocated portfolio. I want to make sure that we protect it. Okay, next we're going to go to the real estate. Real estate the data is a week behind. So understand that even though I get the data from Realtor.com, they post it every Thursday, and I dump it into my spreadsheet, and it creates all these beautiful little graphs. The long and short of it is we're still a week behind. So what that means is that we have not seen the new Fed rate increase affect the markets yet. We are not seeing any of the reaction to the current market sentiment. We are literally about 2.5 weeks behind on this data, but it's very telling overall. So what's happened is we've seen the dynamic price trend modeling system move a bit bearish. And what this was, in my opinion, this was anticipation that the Fed was going to move into a pivot before they raised rates about a week and a half ago. So this is basically anticipation of a potential Fed pivot, which didn't happen. That means that we're going to likely see this move back into a downtrend where the orange line moves back below the blue line. We're likely going to see the price reductions, which is this gold line up here, start to move higher again. We're likely going to see days on market, which is this silver line here, start to move higher again. We're likely going to see listings tighten up a little bit as we move into December, November, and December. But the markets are going to, the global or the real estate markets are going to unwind a bit. That's just the way it is. The modeling system is the real price factor is minus 29.72, down almost a little over 1% last week. The price or the market demand system, modeling system is minus 26.88, both very negative. Understand this is not great for real estate, but the demand factor increased by 1.17. And that was, again, based on this modeling system. It was expecting, the market was expecting a Fed pivot, a bit of softening to spark real estate. I don't believe the Fed's going to do that. If the Fed was smart, like I said, 0.5% or 1/4%, but I don't believe the Fed has any intention of trying to about face, start to move into QE right now. They're going to be moving more into tightening, but I think they're going to be a little softer on it. And let's go the other direction. The primary market data is showing us that real estate price trends have elevated back towards a neutral flat zone. This is year over year. So understand that this is based on year over year data. We had a kind of a depreciationary phase from April, May, June, July, August, taking place actually from about here to about here. We've come back up to everyone anticipating markets are going to hold up a bit. Pricing is fairly stable. This is going to probably decline. Real estate price reduction activity has started to decline. This was because, again, everybody expected the Fed to make a pivot. This is likely going to turn back around as people start to try to liquidate. Now, understand that this is a very interesting market dynamic. Those that are forced to liquidate are going to be looking to liquidate because they're going to be forced to. Those that are not forced to are going to be trying to hold on for as long as they can. So we really need to see what happens over the next 2 or 3 months. But the dynamics of the market have really changed. Look at this. The new real estate active listings change. Active listings have plummeted. So what's happening here is active listings have come off the market. What you see on the market right now are those that are either in a strong cash position, can sell and relocate or whatever, or they're forced to sell. You're not seeing a flood of properties on the market right now. You can see prior to this, we had stayed in a fairly narrow range, and then we had COVID and all of these rotations. Now we're at extreme deep lows with a little tick up at the very end. Little tick upward over here at the very end, which is telling to me in the sense that I believe we're going to start to see listings come on the market. We're going to see price reductions come up. People who are going to try to cash out are going to try to cash out expecting the Fed to raise rates. And this could carry on for quite some time. And then the new listing count metrics, this basically tells you that new listing counts are increasing slightly. Okay, this is a little upward number here. So new listings are coming into market. Active listings are actually decreasing. You see the new count change has moved positive. That's the gold line. And then you see the new share of market is now turning positive as well. So share of market has gone up 0.09. New count change as that's the gold line is actually down week over week. So it looks like it's been ticking up, but it's kind of flat right now. And then new listing counts is up 30%. So this is telling you that you're getting a bit of a new little upward tick in new listings coming in. Total active listings is still very, very depressed, but you're starting to see new sales, new listings come on the market. More and more people are trying to sell. This is going to likely tick upward as we start moving into the end of the year and people forced to sell. So we're getting into that mode where real estate and pricing is going to move into that early fear stage. We haven't really seen it yet, but it's going to move into that early fear stage. Are we at a housing market crisis? No way, not yet. We haven't gotten there yet, but could by early next year, depending on what the Fed does. All right, guys, leave comments. Let me know if you have any questions. This has gone on a little longer than I thought, but it's okay. I'm trying to deliver you all of the information that you need to make educated decisions regarding your investments, your wealth, and your future. Pay attention. There's going to be some really great opportunities setting up over the next probably 6 to 12 months, maybe a bit longer. But all of these are going to play out for opportunities for us if we protect our capital and preserve our wealth throughout this craziness right now. All right, guys. Next, we go on to the final video for me today.